President Donald Trump on Liberation Day unveiled long-promised tariffs on all countries and what he described as kind reciprocal tariffs on nations he claimed were the worst offenders in trade relations with the US. Markets are deep in the red on Thursday, with S&P 500 down 4.61%, QQQ is down 5.22%, and Dow Jones Industrial Average is down 3.84%. But remember, when you own a stock, it is not a lottery ticket. You own a part of the business. So in this video, I will go through the big tech stocks and see how the announced tariffs will affect their business, and I will assign the rating for all the Max 7 stock, which I believe is a buy, hold, or sell in the current situation. What's going on, investors? Hope you guys are doing well out there. Before we go deeper into Max 7 stock, we need to understand who is the largest trading partner of the US. And if you can see here, the largest trading partners are Mexico, China, Canada, Germany, countries from Europe, Japan, Taiwan, and countries like this. Some countries already responded to the tariffs. Canada imposed 25% on the vehicles imported from US. Germany and France are very aggressively and planning their response as well. And for China, China is taking time to respond as well for the tariffs provided by Trump. I see many questions and people are confused. What is the final formula of tariffs and how it was calculated? For example, the US buys more goods from China than it sells to them. There is a goods deficit of $295 billion. The total amount of goods is buy from China is 440 billion. Dividing 295 billion by 440 gets you to 67%, and you divide that by 2 and round up. Therefore, the tariff imposed on China is a 34%. Similarly, when it applied to a European Union, the White House formula resulted to a 20% tariff. Is there any exceptions from the tariffs? Yes, there is. Some goods will not be subject to reciprocal tariff. This includes steel, aluminum, auto parts, copper, pharmaceutical, semiconductors, lumber, energy, and some other materials which is not available in the United States. Now, after having the background about the tariffs, let's go through the Max 7 stock to understand how this affects our Magnificent 7 big tech stocks. Meta Platforms relies on ads for 95% of revenue, mainly through Facebook, Instagram, and WhatsApp. Unlike hardware-heavy firms like Apple or Tesla, Meta is less exposed to direct tariff effects. But there are key considerations. First one, the Reality Labs and the hardware Meta's VR AR division depends on imported components. But with Reality Labs contributing just 0.6% of the revenue, the impact is minimal. Data centers and infrastructure, Meta's heavy investment in servers and network hardware, could face cost pressures if tariffs affect imports. There is also indirect economic effect. Tariffs drive inflation, potentially reducing consumer spendings. Higher costs could force businesses, especially small and medium-sized advertisers, to cut the budget, affecting Meta's revenue. A broader slowdown or recession could amplify these risks, making ad-dependent companies like Meta vulnerable. Looking at price to operating cash flow of Meta, Meta is currently trading at 14.04 with medium of 15.22, which means a little bit lower than 10 years average. I would put Meta into the hold territory because I believe that if we are going to the recession and if this tariffs is going to be executed and going to stay for 1 or 2 years, I definitely believe that economic slowdown is inevitable. So in this case, I believe that Meta could go lower because Meta is heavily relying on advertising. Coming to the next company in the list, and this is Tesla. Tariffs impacting Tesla due to its global supply chain and manufacturing in China. It will increase costs for Tesla vehicles and components, particularly from its Shanghai Gigafactory, which supplies both China and export markets, potentially squeezing its 17% gross margin. Tesla may need to absorb costs or raise prices, risking demand in a price-sensitive market amid inflation. However, 25% tariff on imported vehicles could benefit Tesla's US production, giving it an edge over foreign competitors. Economic slowdown fears 35% recession chance within 12 months, as Goldman Sachs is predicting, may dampen EV demand, especially for Tesla's premium models. Overall, tariffs present a mixed impact with short-term challenges but potential domestic advantages for Tesla. Forward price to operating cash flow, Tesla is trading a little bit richer than 10 years average, and I believe that Tesla is overpriced here. And if we believe that economic slowdown is inevitable, probably Tesla's demand will go down even more, which make it more challenging for Tesla. And also, if the price of the vehicles is going up, I believe that Tesla is somewhere between hold and sell, but I would assign Tesla to sell because we do not really have a lot of revenue stream from software and from robotics. So unfortunately, as for now, Tesla is a car company, and for the car company, this price is a little bit expensive, especially the uncertainties we are facing right now. The next company in the list is Amazon. Amazon's diverse business model includes e-commerce, AWS, and advertising. Amazon's marketplace relies on imported goods from China and other countries. Tariffs on these imports will raise costs, especially in its logistics and fulfillment operations. For AWS, the cloud business depends on hardware for its data centers, some of which may be imported. Tariffs could increase these costs. And for advertising, as a growing segment, it could be impacted by reduced consumer spending due to inflation caused by tariffs, similarly to Meta. In terms of the forward price to operating cash flow, Amazon currently is dirt cheap with 14.4 forward price to operating cash flow, while 10 years average is 19. I believe that Amazon is very undervalued here. I believe that Amazon is a buy. Just to make a warning, I think there is a more pain ahead of us, and I believe that all this company, because of the high volatility, could be lower than currently. So let's say if you do not have any position in Amazon, I think it makes sense to start the position, not financial advice, of course. Amazon is already a very large position for me. So to add more shares, I would wait for more juicy prices. For example, 175 as a previous all-time high to technically retest the all-time high. So for me, 175 would be a relatively interesting price. And of course, after that, averaging down if Amazon is going lower. The next company in the list is Nvidia. Based on the statement from a White House, semiconductors will be one of the exceptions. I'm not sure all the components needed for Nvidia chips will avoid the tariffs, but the future recession could limit the spending from hyperscalers, which will slow down the revenue growth for Nvidia. In terms of the forward price to free cash flow, Nvidia is trading with 27.5 with medium price to forward free cash flow of 36.8. So this is undervalued based on a 10 years average. But I believe that Nvidia could have risks there, and Nvidia could go lower because we already see the potential signs. For example, chairman of Alibaba is saying about the bubble in AI spending, and also we saw the news that Microsoft is scaling down some of its capex. So I believe in the next earnings report, Nvidia could give us some signs for the future growth, and it could be not very beautiful. So I believe that Nvidia here is not undervalued enough. I would not put Nvidia into the sell category, but I think Nvidia is a hold, and probably at 90 we can average down. Depends on the cycle and depends on the guidance from Nvidia and also from biggest hyperscalers. The next company in the list is Apple. New tariffs of foreign imports will hit Apple hard due to its reliance on China for manufacturing. Higher production costs for iPhones and Macs could cut into Apple's 45% gross margin or force price hikes, further hurting demand amid stagnating revenue. While Apple is diversifying its supply chain to India and Vietnam, it remains heavily exposed in the short term. Increase of inflation estimated 0.7% by Goldman Sachs and potential recession of 35% chance could further reduce spending on its premium product. Retaliatory Chinese tariffs may also threaten sales in key markets. 20% of Apple's revenue is in China. However, Apple's high margin services segment with 25% of Apple's revenue and 70% margin offers a cushion. From the perspective of valuation, Apple is currently trading at 27.81 forward price to free cash flow with a medium of 20, and I believe Apple is significantly overpriced here, so I would put Apple into the sell category. I understand why Wall Street is not selling Apple from the beginning. This is a very stable company and the customers love Apple and ecosystem is very strong. But I believe that the valuation and also potential recession in the future makes Apple one of the weakest among Max 7. Microsoft, one of the strongest company in the world with huge recurring revenue. And of course, cloud could take a hit because of tariffs. LinkedIn ads could take a hit because of potential recession and job losses. But I believe that recurring revenue provides Microsoft a significant margin. The problem of Microsoft is that it did not correct enough. You can see it's currently still sitting on 10 years average. So if we're going to the bear market, if we were going to the recession, I believe Microsoft could go a little bit lower. So I would put Microsoft at the category of hold. And if Microsoft goes down 10 to 15% more, I believe that Microsoft will go to the buy territory. But right now, we will leave it as a hold. Coming to the last company in the list, for Google, tariffs affecting Alphabet primarily through the indirect economic impact. As a digital-first company, Google is less exposed to direct tariff costs with a revenue around 307 billion in 2024, driven by advertising, which is 77%, cloud and services like YouTube. However, inflation from tariffs and the potential recession could reduce ad spending, similar to Meta and Amazon, impacting Google's core business. Google's cloud and AI hardware, TPUs, may face higher costs for important components. Overall, tariffs pose short-term risks to ads revenue and stock performance, but Google digital focus limits direct exposure. In terms of the forward price to operating cash flow for Google, it's relatively cheap, sitting at 12.6 comparing to 10 years average of 15. So I believe Google is significantly undervalued here, and if you do not have position in Google, I think it makes sense to start the position, not financial advice again, but I think the price for Google and Amazon are already very juicy. For the long term, these two companies significantly undervalued and provide a generational buying opportunity at these prices. It could go lower on a short and medium term if we are going into the recession, so investors need to keep that in mind. I hope you enjoyed the video. Please like and subscribe to the channel if you do, and I'll see you in the next one.